welcome back, ICA. What we want to talk about next is a part of the options market, but also another mechanic to how the actual stock market moves, how the actual equities also move. Now, remember in the very, very beginning when we started, we had this talk about how there are two different sides to to how price moves. You have the bulls, you have the bears, okay? And as a result, they have this particular game plan and a side that they're on until the very end. What they do at the very end is they will take the other side in order to finalize their position. Now, the big difference between your buyers and your sellers when it comes down to the equity, when it comes down to the stock itself, is that when you buy something, you physically, or not physically in this situation, you digitally have rights to the stock, okay? When you sell it short and take the other side, what you actually do is you actually borrow, okay? You borrow from a company, you borrow from an institution, from your brokerage. You end up paying them a percentage fee, a little bit of interest as a rate to short or take that position. So understand that when you short or when you take the bearish position on a equity, that's called shorting, and ultimately it creates a negative pressure upon the stock. But at the end of the day, when they decide to profit or decide, if price does continue going down, they have to buy back at the low. So ultimately they have sold or sell high, buy low, okay? Instead of the buy low, sell high. So it's still a way of profiting, but keep in mind the short game is a little bit different because of the way that interest and the time component actually takes a toll upon shorts. All right. Now, with that being said, we have to understand that there are these additional pressures and additional mechanics to how the market moves due to the way that selling first and having to borrow this plays upon the psychology and plays upon these short position takers. Okay. So with that being said, let's go into this next slide here and talk a little bit about one of the most famous shorts you may imagine. Michael Lewis wrote a story about this, but the Big Short is based upon Michael Burry, who Christian Bale was the main character of, okay? And what Michael Burry had done in 2008 was actually he decided to bet against the housing market. He sold high and he was looking to buy back low after it had crashed. But understand, though, that he actually ended up selling not at the top, but while price kept climbing, okay? While price kept climbing, for him, you got to remember, below his position would have been profitable. Below his position would have been profitable. But at this point, he was actually in the red. He was actually losing quite a bit. And he was putting his fund or his firm in trouble simply because he was taking this. He was having a lot of people telling him he was being stupid, that he was betting against the housing market that was never going to fail. But he had done his research, he had done his due diligence, and determined that price wasn't going to sustain itself, and decided to short the market. Now, while he was in his position and while things were going against him, he actually owed lots, like millions and millions of dollars. He actually had to pay more money to hold his position because it was losing so much money. And remember that by borrowing those shares, you're paying this interest. And ultimately, until you buy back those shares to return, even though those profits or those losses aren't realized just yet, that interest is going to cut into those profits and works a little bit differently than the way that we're used to. Now, what you want to understand, though, is that when a lot of people decide all to short together at the same time, and price pushes very, very far down to lows, and then everybody buys back together at the same time or suddenly buys back, price can shoot up very quickly because of, you can imagine it's, if it was the pressure of something on top, that's selling pressure. And then when you have the buying pressure from below, when everybody gets out at the same time, it can push price away very, very quickly. And so that's actually what ends up happening is shorts have this really interesting risk to the way that they're positioned, and that the market actually had some really interesting dynamics to the fact that shorts were able to suppress the price of a stock so much that they were able to somehow short over 100% of the stock, meaning that, if my lemonade stand, Johnny's lemonade stand, had 1,000 shares of stock ready to trade, they somehow were selling 1,000 plus shares, making it very hard for certain stocks to stay profitable if there are so many people piled up against them. But this is a situation that was actually, we'll get into it in a moment, that actually led to not only a Volkswagen squeeze, but will also lead into what we call a short squeeze and a gamma squeeze. And the most famous ones that we actually understand, Volkswagen was the original, the very original squeeze. But for those of you that are a little bit familiar with the past few years, there was the GameStop and the AMC squeeze that did also happen. In particular, we'll get into a little bit more detail of this, but here I just wanted to point out how short interest is a way to measure what percentage of the stock is actually being sold or have sold positions against them. And in this situation, you'll have noticed that GameStop somehow has 138%. So again, if they had 1 million shares to, 1 million shares of stock for the entire company, somehow 1.38 million shares have been sold and technically are outstanding right now. And until these actually come back and are put back into the system, these shorts all have interest against them. Now, in terms of the interest, what I want to point out is there's a very particular measurement called the cost to borrow. So in here, this is just a more recent poll of AMC, actually, just something that was posted online. And what you can see here is there's a cost to borrow. I want you to notice here that the cost to borrow for AMC is 182%. Okay, so that's paying quite a premium to hold on to this. And you got to understand, as time ticks away, these people are eventually going to look to try to get out of their position. We'll get a little bit more in detail about shorts and gamma, especially the squeezes, in the next video. But what I want to point out here is that the way that shorts work and the way that the game of shorts actually is, they actually are going to be pitted against each other, because as we buy back, let's say as shorts buy back, price goes up. And shorts, their cost to borrow will keep eating away at them if they don't get out. So sometimes they might just finally give up if price keeps going up against them, eventually squeezing people out or getting them out of the position because it's no longer profitable, and the brokerage or whoever they're trading with is actually demanding money back. So with that being said, understand that the shorts game is the opposite of the buying game, but because of the way that shorts are positioned, there's actually, if things go against them, a possibility of an unlimited loss. That's what I want you to understand. So a short squeeze can actually cause very, very high and quick, rapid price movement to the upside. And as a result, can put some shorts in a very, very bad position. Not only do they owe the interest, but they also have to buy things back with the market or with their brokerage demanding them for money that they owe. So understand that the things with shorts, something to consider. The percentage that is shorted is always important. Now you don't really see these 100% anymore with things like AMC, GameStop, etc. But cost to borrow, the percentage that it costs to borrow, gives an idea of, you know, what they're willing to pay at this point in order to borrow at this, and understand also that the utilization rate is an idea of how much of the market or how many of the available shares are being shorted. And those are always important to keep an eye on. You know, terrible companies that lose a bunch of money are very likely going to be highly shorted, and there's going to be a high demand for them, which pushes the cost to borrow higher. People are willing to borrow near or at these prices or percentages, showing that there's very bearish sentiment on it. But as well, as soon as they start to get out, you can expect that they may squeeze and price will shoot up very quickly. Let's go into some of our charts, because I do want to show you guys this too. That's a lot of times too with long-term and big picture situations. I want you to understand that some of these big pushes away from new low prices is the beginning of a short squeeze that leads into a gamma squeeze. Short squeeze that leads into a gamma squeeze, because they're getting themselves out of those short positions and it pushes price back up. And so large volatile pushes, and you can also see little spikes of green buys in situations, those can be considered and interpreted as those short squeezes. Same here, when GameStop was near its lows, I want to point out, right? The very first little short squeeze, it looks tiny now. Let me put these, if I put these bars over to the side, you'll see how these get bigger. The first group of shorts getting out here, getting out near the lows, makes price pop up very quickly, because they end up being pitted against each other to try to get out before the room burns down. Again, we'll get into more details on shorts and gamma in our next video, but for this one, I wanted to give you guys an idea of the fact that there is this downward pressure and there is this selling pressure that comes from the top when it comes, you know, due to the fact that you can also borrow to sell, and that's what will create these downward pressures and downward pushes on the market. Okay. All right, with that being said, I'm glad you guys are following along. I'll see you guys in the next video, where we're going to continue talking a bit more about the shorts and the gamma.